Welcome to Talk Tickers. We're diving into AutoNation Incorporated's first quarter 2025 earnings call today.
That's right. And the main story seems to be, well, pretty strong performance across the board.
Yeah, exactly. Despite, those tariff concerns kind of looming in the background.
Definitely. We saw good growth in new units, really impressive profit gains in used cars and financial services.
And after sales too, right? Record profits there.
Absolutely. So let's maybe break down what actually drove these results and what management's take is on navigating this, well, uncertain environment.
Sounds good. Let's start with the results snapshot. Give us the highlights.
Okay, so first off, strong Q1. As we said, new unit growth was notable. Profitability expanded in used and CFS, and after-sales hit records.
And the same store new vehicle sales, how did those look?
Up 7% compared to last year. And interestingly, premium luxury led the way, up 14%.
Wow, 14%.
Yeah. Domestic was up 6%, imports up 2%. And it seems like things really accelerated after those tariff announcements hit in late March.
Okay, we'll definitely need to dig into that tariff angle more. What about used cars?
Big jump in profitability there.
Yeah.
Unit profit up 13%, hit $1,662.
That's quite a number per unit.
It is. And the total gross profit, including wholesale, that climbed 12% versus Q1 last year.
And customer financial services, CFS, consistent strength?
Yeah, continued strong performance. Per unit profitability actually ticked up sequentially again, second quarter in a row.
And after sales.
Record gross profits, like we mentioned. And they expanded their margin pretty significantly, up 140 basis points year over year.
Okay, so operations look solid. Did that translate into cash flow, share buyback?
Yeah, good operating cash generation. They put about $225 million into share repurchases.
At what price level?
Average price was $165 per share just in the quarter. Year to date, it's over $250 million. That's actually cut the share count by about 4% since the start of the year.
So returning capital to shareholders is clearly a priority. How did that feed into the bottom line, the EPS?
Well, adjusted EPS saw its first year-over-year increase in, get this, 8 quarters, up 4% to $4.68.
Finally turning the corner there on year-over-year growth.
Seems like it. Revenue hit $6.7 billion. That's up 3% year over year, or 4% if you look at just same stores.
Yeah.
That was really pushed by a 10% jump in same store new vehicle revenue.
Okay. And adjusted net income.
$184 million. Now, that was down 3% year over year.
Okay.
But importantly, that's the smallest decline they've seen in 3 years. So the trend is definitely improving.
Right. Context is key there. Okay, let's get into the deep dive. You mentioned that new vehicle sales surge, especially after the tariff news. Was it all smooth sailing?
Well, yes and no. Management definitely acknowledged the growth was strong, but they pointed to a likely pull-forward effect in March.
Meaning people rushed to buy before potential price hike.
Exactly. Pulling sales from later in the year into March. And they did see things moderate a bit heading into April.
Okay.
They also mentioned they have some pre-tariff inventory on certain models, which should help them, keep momentum going into May.
But the longer-term tariff impact is still a bit fuzzy.
Very much so. Availability, pricing, consumer demand, it's all uncertain as the manufacturers, the OEMs, figure out their supply chains and pricing strategies. It's a big question mark.
Did management sound worried, or do they feel positioned okay?
They seem to highlight their broad portfolio as an advantage. The thinking is, if tariffs hit certain brands harder, customers might just cross-shop within AutoNation's network to less affected brands.
So that diversification could act as a bit of a buffer.
That seems to be the hope, yeah. It might cushion an overall market decline, at least for them.
Okay, interesting. Let's pivot to used vehicles. That 13% profit jump per unit is substantial. What's behind that?
It really reflects a clear focus on margin, on costs, managing inventory levels carefully, getting the vehicle mix right.
So less about just volume, more about profitable volume.
Precisely. And it's worth noting their used inventory actually hit its highest point since December 2023. So they have cars to sell.
Where are they finding these cars? Is supply still tight?
They source over 90% internally. Think trade-ins, lease returns, plus their We'll Buy Your Car program.
Keeping it in the family, so to speak?
Right. Demand is apparently very strong for cars under $20,000. But yes, supply is still a bit of a challenge for the mid and higher priced used vehicles. That's kind of a hangover from lower new car production a few years back.
Makes sense. Okay, let's talk customer financial services, CFS, and their captive finance arm, AN Finance. CFS keeps performing.
Yeah, very consistent. Like we said, PBR, that's profit before tax per retail unit, was up sequentially again. by 3%.
And that's even with their own finance company, AN Finance, growing, because sometimes that can dilute things initially, right?
That's exactly the point they made. It's impressive because AN Finance is ramping up. It does slightly dilute the headline CFS PVR in the short term, but the strategy is clearly about better long-term returns from originating their own loans.
And how is AN Finance doing?
Quite well, it seems. It actually hit profitability ahead of schedule.
Oh, really?
Yeah, and originated $460 million in loans just in Q1. That's way up from before.
What about loan quality? Any concerns there?
Actually, they stressed the credit quality is improving. Average FICO scores on the new loans are going up. Delinquency is stable, around 2%.
How are they managing that?
It seems to be a shift in who they're targeting. Plus, they sold off some legacy subprime loans. And a big chunk, about 74% of the AN Finance portfolio is funded with non-recourse debt.
Which frees up capital.
Exactly. Frees up their balance sheet for reinvestment. And they're actively prepping for their first ABS, asset-backed security funding program.
So building more sophisticated funding structure there. Okay, what about the last piece, after sales, service and parts?
Another bright spot, record gross profit, like we noted. And that margin expansion, 140 basis points, is really healthy.
What drove the margin improvement specifically?
A few things. They got better gross profit per repair order, and total repair orders also increased modestly. But the margin boost came from better parts and labor rates, higher technician efficiency.
Getting more out of each mechanic hour.
Right. Plus scale benefits and just handling more complex, higher value service jobs.
Are they able to find enough technicians? That's usually a bottleneck.
They're working on it. Technician headcount grew 3% of the quarter.
Yeah.
It's a continued focus. They feel physical bay capacity is mostly okay, but getting more skilled techs is key.
Yeah.
Especially to tap into that market for older vehicles, 7 years plus.
Right, the ones out of warranty that might go elsewhere. So wrapping up the operations, strong cash flow enabling investment and buybacks. How did they balance it all?
Well, CapEx was actually down year over year, $75 million. They did make a strategic acquisition, 2 stores in Denver, for $70 million.
Increasing density there.
Exactly. And the share repurchases were significant, as we discussed. It's all about generating strong returns on invested capital. Their leverage is comfortable, 2.56 times EBITDA, right in their target zone.
And still looking for more deals.
Yeah, they said they're actively exploring M&A, but only where they see returns beating their cost of capital. Disciplined approach.
Okay, very comprehensive picture. Strong quarter, managing well, but with that tariff uncertainty, definitely hanging out there.
For sure.
All right, let's shift gears. Time for our This Is Not Financial Advice segment. Based on this AutoNation call, what's an outrageous but plausible trade idea?
Okay, so thinking about AutoNation's focus on used vehicle profits and those supply issues for higher price used cars. Yeah. Here's one. Maybe look at companies that support the used car market, specifically parts retailers that cater heavily to older vehicles.
Why them?
Well, if new cars stay expensive, maybe partly due to tariffs, people might just hang on to their current cars longer.
Right. Okay, yeah. More repairs, more maintenance.
Exactly.
Yeah.
So increased demand for parts and service on an aging car park. Businesses specializing in parts for older models could, disproportionately benefit.
Interesting angle. Betting on people keeping cars longer? I got another one.
Yeah, building off the AN Finance story, their captive finance arm hitting profitability, getting ready for ABS funding. Consider a speculative look at a small, maybe recently public ABS ETF, specifically one focused on auto loans, but maybe with a tilt towards improving credit quality pools.
So betting that AN Finance isn't the only one managing auto loans well.
Kind of. If their success points to a broader trend where some lenders are originating and managing portfolios well, even outside prime, those securities could see more demand, potentially tighter spreads. It's a bit more complex, obviously.
Definitely more complex. And you'd need to watch interest rates and the overall economy closely there.
Absolutely. Big caveats on that one. It's definitely in the outrageous but plausible category.
Good stuff. Some real food for thought there. So, wrapping up our deep dive on AutoNation's Q1, solid execution, navigating potential tariff turbulence.
Yeah, the strength in used cars, the progress with AN Finance, and the record after sales really stand out.
But that tariff situation is definitely the wild card to watch. For them and the whole industry, how they keep adapting will be key.
For sure.
So what stood out most to you listening to this? Are those tariff worries maybe overblown, or is this a real potential disruptor? And what about their capital allocation aggressive buybacks the right move right now?
Lots to chew on.
Definitely. Remember, this is just our analysis of the call. Always do your own homework. This isn't financial advice. Thanks for joining us.
We'll catch you on the next earnings deep dive.